Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table.
Well, welcome to today's podcast. Today we're going to be diving into financial deal components. And so we'll go ahead and start with seller financing. And to some of you who may be listening, this could be a little elementary to you. But there are a lot of nuances to seller financing and a lot of different components to it. So we're just going to dive in. So Dave, Andrew, when is the best time to use seller financing?
Oh man, yeah, the best time to use seller financing. I mean, I think it's going to be based on the buyer, and so the buyer needs to fund it in different ways, and so we on a previous episode we kind of talked about how we don't. When you're the seller, you may or may not really want to finance the deal if you're going to be behind a series of debt, right? And so it's just a way that you can allow a different source of funding for someone to buy your business. And so the best time, I mean, a lot of individual buyers, I mean, they'll go to a bank, but a lot of times a seller might finance a deal to them. Those will be smaller deals, pretty popular, although SBA is very popular as well. And so you don't always necessarily need seller financing. And so really it's your appetite. That's what I would say is the best time is to figure out what your appetite is. Are you willing to wait a little bit to get your money for your business? That's essentially what it is.
Let me pipe in here on the SBA thing just for a moment, because I think that's important. So a lot of smaller deals, SBA is lending up to, I think it's 5 million right now. And I think that they're getting ready to raise that up to almost 7.5. And so actually we do have a lot of requests for seller financing in SBA deals, because here's why. Most of the people who are buying a small business may not have a lot of liquidity. They may not have a lot of cash sitting in the bank to use. But if SBA is going to require 20% down in that particular deal, or 10% down, they've got to figure out if it's a $5 million deal, well, that could be $1 million. What they will allow up to a certain extent is they will allow a seller to seller finance part of that down payment to the buyer, but they will put stipulations around when that can be paid off and at what level it can be paid off, how quickly it can be paid off. And oftentimes it can't be fully paid off until the loan to SBA is paid off, or it reaches a certain amount. That's a little bit of negotiation that can happen depending on what bank you're using. And so, that's one way it can be used really effectively, because some of these smaller deals just wouldn't get done. I mean, it's like 80, I think I've said before, like 80% of smaller deals have an element of that. But let's talk about just in general what it is.
Yeah, Dave, let me add in there as we're on the topic of seller financing and SBA, and what I've heard or what I've learned is that if that 15% is, SBA is going to require most likely 15% as kind of a down payment, and I'm no banker, and so
No, we ought to have a banker on here with us though one of these days.
Yeah, I know, and we'll definitely get a banker, an SBA lender to come and to teach us a little bit more. But I think that and when we're kind of going after a business, if you're buying and you don't have that 15%, there are times where that seller financing, if the seller can kind of accommodate for that. However, they cannot. The only sort of payment that they'll be able to get before the SBA is completely paid off is interest payments. And so, I mean, that said, we can kind of figure out ways around that, especially if you can pay for that 15%, or if you can pay for that 15% down payment, then any other seller note, you can actually pay that off, but it is going to be secondary to the SBA.
So one thing that was pointed out to us is that we use a lot of these senior debt, primary debt, and we had some listeners say, I think we need to explain a little bit more about what that means, and that's understandable. Sometimes, like we always say with these, these silly acronyms, you talk to. I always laugh because when you meet PE groups and stuff, new PE groups, especially large ones, they're throwing acronyms out left and right. I think it's like this, intimidating acronym volleying going back and forth, which I find extremely silly at my age. But so let's just be really elementary about this. Everyone, if you own a home, you went and got a mortgage on your home more than likely. And some of you may have taken a second mortgage on your home. We used to own a mortgage company. It was one of our businesses. We would often, because they wouldn't have to pay mortgage insurance if the first lien, the primary mortgage lender was at 80%, or if they were at 80%, they wouldn't have to pay mortgage insurance. So, but if someone only had 10% to put down, that meant that there was 10% of that 100%. So if you buy a house for $100,000, first lender, the main lender, the senior lender in that case, we would call them, is going to loan $80,000. You've got $10,000 to put down. That leaves that $10,000 gap. We would fill that with a second lien from a different bank, a higher interest rate, possibly a shorter term, and they would be in second position. If I foreclosed on that house, or if I walked away from that house, or I couldn't pay my house payments, the senior lender, the primary mortgage person who loaned me $80,000, they would come after the house first. They have first priority on the collateral. Okay, if that collateral is satisfied, then the second lien people would get their share if there was anything left. Let's say they sold the house for $85,000. They satisfied their $80,000. Then the second lien, got $5,000, and then they would be out of luck on the other $5,000. So it's a higher risk loan. In the M&A world, mergers and acquisition world, you would call it senior debt. It would be a little less expensive. It may be from a bank. It may not be from a bank. It may be from people who specialize in senior debt. They may also be taking some equity position in the deal. There's different ways that is done from a buyer side, which we're not really talking about. But and then you also hear this term mezzanine debt or mezz debt, which is basically they're in a second position on that debt. And so when we start talking about seller financing, what becomes important to us as M&A advisors is if I'm selling your business and they're asking you to finance part of that, I'm going to help you determine what interest rate to charge, what would be kind of market in that, because it's not going to be the same rate as a first lien lender. You're going to get more interest rate, you hope. It's going to be on a different term as far as time frame. And you can discuss the terms, if maybe a business does a certain amount of business, maybe it's accelerated in its payoff, or, there's different ways to work that out. But what I really want to understand is if that company fails, or if they stop making payments, what's your recourse? What do you have? What's the collateral you have to go back on? And also, what position are you in? How much money is in front of you? So a lot of private equity deals they're coming in with maybe 20 or maybe 30% of equity, and then they're financing up to 70% of the deal. Or maybe they're financing 50 with the senior debt. That's just a lot of money to be in front of you. And a lot of buyers or sellers are like, no, I don't want to do that unless they understand what their position. And then how do you protect it from not being diluted to where another lender can stand in front of you at some point? Does that make sense, Mason? Is that kind of?
Yeah, no, that makes sense for sure. So you mentioned the interest rate, and we determine what goes into setting the interest rate. How do we come up with the interest rate that we would advise a client on?
Well, for a while, we were probably doing, if a seller was getting, 7, 8, 9% on a second lien, that wasn't too unusual. But right now, that's what first lien, that's what senior lenders are charging, 8.5, somewhere along in there.
That's what prime is, right?
Yeah, so I think the latest deal I saw come across was somewhere in the 10, 11, 11% range. And it could be that maybe it moves with prime as well, kind of like the senior debt does. Yeah. So the other thing I think you have to realize is what's the collateral. So we do a lot of deals in the healthcare space and a very specific healthcare clinic type space. Well, it's a freestanding emergency room. So we do a lot of deals in that. And one thing that we have to be very cautious of is when a bank is looking at doing a deal, they want to make sure that they have the accounts receivables. That's a big part of the asset they want their clause into. And understandably so, right? Because that's where the value is. If the business goes down, they can continue to collect on those accounts receivables. Well, that is one piece of collateral that a second lien will not be able to be secondary to, more than likely. I mean, they might be able to be, but the bank is going to basically have to subordinate or basically say, we understand that there's someone below us, and that you're going to have to basically say, if you're the one offering the seller financing, you're going to have to sign a subordination agreement saying you understand that the bank has first position in that. But sometimes those are tied to separate lines of credit, and so it's just another reason you've got to have people who understand the nuances of all of this and all the different options to be on your side.
Yeah, and honestly, I think that it's interesting to see bankers respond to these higher interest rates right now, and so just you kind of see people being a little bit more creative, and I say that very conservatively, because I think bankers probably don't want that to be.
Creativity and bankers don't always go hand in hand.
Yeah, they're not really creative anyway. But
although we've got a couple we deal with that can get really creative. That's when we love to deal with them. But they're deal bankers, which is great.
And there are different promotions that they'll come out with, and so really just talking with different bankers. Don't just talk to one, talk to a few, and kind of see what else people are offering. You just don't know. Although they might be similar, there might be some differences that might go into that might benefit different deals differently.
Yeah. And by the way, if we've got people here, there's a lot of our potential sellers that we're talking with that are wanting to tuck in companies. So they're out looking for buy side deals, right? So we've got a couple people out right now that are out buying a couple things, and then they're going to turn around and sell in a year or two. So, and what we have learned with banks, you've got your major banks that everyone knows their names, but then there's these tertiary banks that are not as well known. They might have a pretty good sized retail presence in some parts of the country or whatever, but they really love deals. I mean, they love to do transactions. They don't necessarily care if it's connected to real estate like a lot of banks. They get creative. They may not be the least expensive out there, but I tell you what, when you find a good, what we call a deal bank, a bank that likes to do deals and they understand the nuances of M&A, it's a game changer.
So when would we recommend seller financing to a seller, or not recommend it?
Well, I think we recommend it when it makes sense from a whole structure standpoint, and when they don't have too much risk. And if it's going to be business by business, Mason, really, because if someone really believes in their business and they know it's solid, if it's a company that's been around 30, 40 years and it's on a great trend, and he's got management in place, he's probably in a pretty safe position. A lot of owners want that because they want the additional income. They want the retirement income coming in. That's just a way for them to keep, if a good interest rate on money that's owed to them, as long as it's, mostly secure. There are times I would not recommend it. And I always get a little bit of a red flag in my gut when someone wants a large piece of it. What that tells me is that they don't have the credit to be able to do it on their own, which then makes me wonder, and that could be just because maybe they're new to the acquisition business and they're trying to, do their first deal, which is great but I'm not sure I want that to be experimented on our client. So, I think or if it's a large amount, if it's a large percentage of the deal, my mind goes to, why aren't you getting this elsewhere? Or if there's hardly any equity being brought in, let's say that they've got a senior debt of 70% and they're wanting our client to do another 20%. It means they're coming with 10% equity. I mean, I'm not really big into deals that are only 10% equity, because I just think that, we're starting to see more and more equity being brought to the table, which we can get into when we talk about rolled equity. But, that's when I would get a little bit hesitant. Yeah.
Let's go ahead and talk about rolled equity. When is the best time to use rolled equity in a deal?
Yeah, just like Dave mentioned, equity is just the term equity, not just rolled equity. We're seeing a lot of equity come to the table. I mean, with your financial buyers, they're looking at financing deals through two major means, right? Debt and equity, and that can be split up in how many ever ways that you want. It could be investor cash, it could be their own equity or cash. It could be the seller's rolled equity. Dave covered the debt portion of it, and really, just like debt, there's many types of equity, and what's the order or the capital stack, if you will. But really, it is fascinating to see people really recently. We've come across a handful of these buyers where they're wanting to, or they have the cash, right? They have the funds, and they're wanting to spend more of it rather than go towards debt or leverage for the company. And I think that it's just fascinating to see that. I think that kind of also generates a little bit more of a kind of, you can call it patient capital, I guess, if you will, where people are looking at more long-term investments, holding the company for a longer period of time. And so because people are looking at equity as a source of funding, they're really wanting to see the seller as part of that funding. And so we enter into this rolled equity portion of a deal. And so really that's what's fascinating about this conversation of rolled equity.
So, but to be clear, Andrew, just to make sure that we got everyone with the defining of the definitions, rolled equity is when a seller chooses to, rather than take cash for a certain percentage of the company, they're going to roll their ownership into the new co or into the new owner. It could be that maybe they're buying, and oftentimes they're buying the current corporation. They're going to retain 20%. Say it's a 20% rolled equity. They're going to retain 20% in the new company and get the upside if there is any in the future. We've done that with some of our companies. And we've seen upsides work. I mean, we call it the second bite of the apple. That's rolled equity versus what we're really starting to see. I know what you're talking about is just the buyers coming to the table with more cash, more equity rather than debt.
Yeah. I one of the questions that I ask any buyer now is talk about debt to equity ratio, right? I mean, what do you, how are you planning on financing this deal? And so most of the time they'll answer, we really want to keep it at a 50-50, or even more equity than debt. And it's fascinating. I don't know if I can't say that's always been that case.
No, it's been typically you could pretty much count on 30% equity, 70% debt in most private equity deals, with PE deals, private equity deals, because they're looking, and it's the right formula for them because they're looking at flipping that thing in 3 to 7 years, depending on what their mandate is. But, interestingly, so the way it works in our companies, Andrew normally finds these different buyers, and at some point he gets me on the phone with them if it's a deal I'm involved with, and I'll kind of talk to him a little bit. We'll kind of find out their history. Do they have a history of retrading deals, or, coming back at the last minute wanting a different price is often done. There's these different things we just want to kind of flesh out at the beginning because we really don't want a lot of confusion. We just want there to be a really straight up good deal, everyone being on the table with things. And so I had my typical conversation. So how much equity and how much debt? And they said, oh, we do all equity. I went, what do you mean you do all equity? Oh yeah, we do all equity. We don't do debt. I was like, what? I mean, this was a large deal. But it put us on, we started really listening in the market more, and we've seen more and more of these folks come up. And a lot of them are investing institutional money. So they're investing money from universities on the endowment programs and things, which is great because their mandate was, we don't sell for 20 years. We're going to buy and hold. So it would make sense on a buy and hold not to leverage it up, but to put a lot of equity in it, especially if there wasn't an expectation of a large payback right away. And so, that's what I know you're running into more and more, Andrew. And honestly, we're out looking for those buyers, because those buyers, I would recommend someone do a second lien with someone like that. When there's no debt in front of them, that's a great time to do a second lien or a seller finance. Yeah.
Yeah. I can't say it. Yeah, exactly. But I think that when you are going to either stay in the business or you trust the management team to take it and continue on, if you're going to exit, I think that unless that's the case, I would maybe almost recommend not doing it. But those are things that need to be in place for sure.
Yeah. Go in deeper on, you said not recommending doing it. When would you absolutely not recommend somebody do rolled equity?
Many times. There are, I think in a couple of other previous episodes, we've talked about a couple different offers. And I think the last time we covered this topic, we mentioned this one offer, and it was proposal where it was promising a lot. And that's one red flag that I see, is when they're over promising or wanting to point you to what they're promising. Yeah, exactly. And look, we try to take those rose colored glasses off, right? I mean, you can't wear those when you're looking at an offer.
That's why I have my business partner. He's a CPA, so he's always got the rose colored glasses. Where's Grant when you need him, right? I'm like, let's go get him. Let's make create. He's like, no, that's a horrible deal. Terrible deal. Stay away from it.
Oh, yeah. You kind of need that cynical side to you, right? I mean, that's essentially what you have to look at what's realistic. And I mean, when you're only looking at what is being promised, or if that's what's being put in front of you instead of anything else, then it's I don't necessarily recommend going at least with that buyer if you're going to roll equity. And so it's more situational than it is a general, hey, would you recommend rolled equity or not?
So it's an investment strategy, right? And I think this might be a good way to kind of wrap this piece up is, we were at a conference not long ago in Missouri, and we're listening to a lot of buyers talking about, and they were saying, look, we stay in this lane. This is maybe it's healthcare. We only invest in healthcare because we know it really well, or we only invest in technology in this particular arena because we know it really, really well. When we start straying outside of that, we get in trouble. And that discipline is what helps really good buyers do well. And so I think it's the same thing with if I'm willing to roll 10 or 20% of my hard-earned value in my company over to someone else, and I don't know that they know what they're doing, or if they're not going to use my management team, or if now my company's becoming a tuck-in and a platform, and I don't know any history about them, that would be like me getting out of my lane. But if I've got my general manager who's coming along for the ride, and he's got equity, and and everything kind of lines up well, and I believe in what they're doing, and I've asked enough questions about the vision of that company. But if I don't know where they're going, and I'm not really, we've all taken pot shot, investments here and there, and we got to go, why did I do that? I mean, it was an emotional thing, and we're looking in the future of what it could be rather than what it realistically most likely will be. And I think so that's when I would say I don't, if you're not going to have any sort of insider control going forward, and none of your people are going to be involved, and they don't have a history of running this kind of company, I wouldn't recommend it to a client.
Yeah. That's great wisdom. Well, that's all we have for today. Thanks for tuning into today's podcast, and we'll see you next time.
And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.